All right, welcome to the next Multifamily Investor Nation webinar. We do a weekly webinar every single week. We've been doing it for a couple of years now and have been pretty consistent with it. And today's topic is going to be about loan sponsors, how to find a loan sponsor for apartment syndication. We're going to be covering what is a loan sponsor, how to select the right loan sponsor and why that's important, how to find a loan sponsor, and then also how the loan sponsor is paid. And of course, we'll throw in several other different things as it comes up and then open it up towards the end for some questions and answers. So before we get started though, I do want to mention one thing to you. So I know I mentioned it a little bit in the green room or before we got started, if you will, but let me go ahead and open up this, share my screen here with you. We have an event coming up on June 10th, 11th, and 12th. It's called the MFIN Summit, stands for Multifamily Investor Nation Summit. It's a live 3-day, all online, all virtual event that is 3 days, June 10th, 11th, and 12th. Right now, it's just under 45 days away. And so you can go to this website, check out our sponsors, as well as the lineup of speakers. We have an amazing lineup of speakers for the June event. And we've been trying to add in some additional speakers, some new speakers, some people you've never heard from before, that are really doing things on a high level with multifamily. There's going to be 2 rooms going on at the same time. We'll have over 50 speakers and usually between about 800 to 900 attendees at this event. So it is the event to be at when it comes to multifamily and investing, because we were the very first multifamily event that went virtual even before COVID. So we didn't do it just because of COVID. We've been perfecting it along the way and already had things down before COVID even hit. So we were kind of in that position to be able to make this a great event for those of you who want to still be able to network virtually, but then also be able to get the content that you want to be able to get and not have to worry about travel. So make sure you go to that website, mfinsummit.com, register for the event coming up. We're looking forward to having you there and looking forward to having this event. If for some reason you're watching this after the event, you can still go to that website. We do this event twice a year, so you can find out more information about the event from there as well. The other last thing I wanted to mention to you is our website, passiveinvesting.com. I'm Dan Handford, one of the managing partners of passiveinvesting.com. I'm not going to go into too much detail about my background, but if you'd like to find out more information, you can go to our website, passiveinvesting.com, click on this little button here called Meet the Team. And in the Meet the Team section, you can see our team members here. You can see my information here. Click on my picture. And when you click on my picture, you will see there's a video there that we created, giving you a little bit of a background about myself, my family, things like that. So you can certainly do that to find out more information. If you would like to find out more information about multifamily and investing with us, you can go to this little blue button at the top right-hand corner. You can click on that little blue button that says Join the Passive Investor Club. And when you click on that button, you'll be able to fill out a form. Let us know that you're interested in potentially looking at some of our offerings that we have available. And one of our team members will jump on a phone call with you, discuss your investment goals, and make sure that you're the right fit for us and that we're the right fit for you, right? At the same time. So with all that behind us, let's go ahead and get started talking about these loan sponsors. All right. I had somebody comment in here in the chat box. Let me see if I can read that here. Nobody who is seriously interested in multifamily real estate investing should ever miss this excellent event. So thank you, Alan, for that. I know you've been to this event a couple of times now and looking forward to having you back again in June. It's an amazing event. You've got to go there, whether you're thinking about getting into multifamily, whether you're already in it right now, just getting started, whatever it is, you've got to come to that event. It's a phenomenal event. We do a really good job. Our team is working behind the scenes every single day right now, putting that event together. All right, so let me go to our page here that we're going to be talking about. So how to find a loan sponsor. So the first thing we need to define and discuss is what is a loan sponsor. So a loan sponsor is somebody who can sign on the loans for the assets that you want to acquire, for the loans, right? And so it's a pretty straightforward, kind of answer of a loan sponsor is somebody who signs on the loan, and they're considered what's called a loan sponsor, or somebody will call them a loan guarantor or a guarantor, right? That's somebody who's going to sign on your behalf. So kind of like when you were growing up and you needed to go buy a car for the first time, you had to go get a cosigner, right? Maybe you had mommy or daddy go get you a little loan and they had to sign off on it because you were building your credit. Well, when you first get into multifamily, you got to build your reputation, right? You got to build your credibility, and you have to have a strong financial backing in order to get these non-recourse loans. So, and even the recourse loans you do as well. But many of the agency lenders and institutional lenders, Fannie Mae, Freddie Mac, CMBS, Liveco, bridge lenders, whatever it may be, they are going to typically require you to have a loan sponsor if you don't meet the requirements of the loan. And this is why it's important to select the right loan sponsor. So this next question we're going to answer is, why is selecting the right loan sponsor important? Well, there's three main things that as a loan sponsor you must meet and to be able to qualify for these loans. So the first thing is you must have, or the loan sponsor must have a net worth of the loan balance. So if you're borrowing $10 million, that borrower or that loan sponsor has to have a net worth of $10 million. Now, that's the first requirement. The second requirement is that they must have at least 10% liquidity of the loan balance. So if your loan balance is $10 million and you need 10% liquidity, you need to have at least $1 million in liquid assets. That can be cash, stocks, or bonds, right? And there might be a few other small like liquid assets that you might be able to have, but they have to be in a liquid form. It has to be in some form of a liquid security. So you can't have them invested inside of real estate or anything like that unless you're investing in some form of like REIT where you can actually sell your shares and pull that money out right away. The third thing that you must have is you must have experience. You must have experience managing assets of the size that you're about to acquire. So those are the three main things, right? And so when you're trying to select the right loan sponsor, you need to make sure you find a loan sponsor that can help you take down the properties that you're trying to acquire. So if you're trying to acquire a $50 million property, you don't want to go find a loan sponsor that's only got $10 million in net worth and maybe $1 million in liquidity. You got to have a lot stronger financial loan sponsor to be able to take down that property. Okay. So that's the main thing that you have to have is being able to have the net worth, liquidity, and experience to be able to take down the loan. So when you're selecting them, you want to make sure you select the right one. Now, one little caveat here is that you don't have to have just one person that meets those qualifications. You can actually aggregate or put together multiple loan sponsors to meet those requirements. So if you need $10 million in net worth, you could have $5 million from one person, $3 million from another, and $2 million from another, right? So you can add up multiple people's net worth to be able to qualify to be loan sponsors, but they would all be together in that loan sponsorship package. They would all three be signing off on those loans and putting up a personal guarantee, right? Now, when you're talking about a non-recourse loan, you might be thinking, well, it's a personal guarantee, but it's non-recourse. And that is true, but there are what are called bad boy carve-outs in these loans, which could convert the non-recourse loan to a recourse loan. And that's any type of fraudulent activity or negligence that occurs on the property or with falsifying financial statements or tax returns or things like that could cause you to be converted from a non-recourse loan to a recourse loan. So keep that in mind as well. Now, how to find a loan sponsor. This is probably one of the trickiest pieces of this is how to find a loan sponsor, but it really depends on how active you are in the industry and how active you are in the space as to how you can find a loan sponsor. So one is you can go to events, right, and start to network with other people who are looking for people like you that they need a loan sponsor, right? There are people in this industry that their main responsibility is to be a loan sponsor, and that's pretty much it. They have a pretty high net worth and they can sign on multiple loans, right? Now, you might be thinking, well, if they have a $5 million net worth, they can only sign on one loan. And that's not true. When you actually only have to meet that requirement on a per loan basis. So they can sign on multiple loans with their net worth, and it doesn't like take away from their net worth because they signed on another loan, right? And the main reason for that is because they're all usually non-recourse loans, right? So the banks are not as worried about those going default and all of them going default at the same time. And the other main reason is that one of the main reasons why they want a financially strong loan sponsor is because if something happens to the property, they want to make sure that they have somebody has a strong financial backing that can help support the property, right? So if for some reason that the property needs it, they can. And it also helps to ensure that the money and the cash flow that is made off the property is used for the property, right? They want to make sure that people aren't just siphoning off money off the property and there's nothing left for the property to be able to pay its debt service or to pay its expenses, right? And so they know that if they put somebody that's financially savvy in place there that has that financial net worth and liquidity, then they the likelihood of it going in default is a lot less, right? Now, you also sometimes see that the leverage on these loans is a little bit lower as well. So especially with Fannie Mae and Freddie Mac, the leverages might be 65 to 70, 75%, depending on the loan balance, depending on the market, and depending on the DSCR and things like that. All of that kind of changes the actual loan to value or the loan to cost ratio when you're looking at these types of offerings or these types of opportunities. All right. So the best way to find these loan sponsors, again, let's go back to this because I kind of went on a little bit of a rabbit trail there, is to be able to go networking at events. Go networking at events, and whether they're in person or virtual, get out there and start networking with people and asking other people that are in the industry, hey, who do you know who is a loan sponsor, right? Who is a loan sponsor that you can actually reach out to and could potentially join you? Now, you want to establish a relationship with a loan sponsor ahead of time, right? You don't want to just go, oh, I found a deal, it's closing in 60 days, and I need someone to be a loan sponsor. You got it backwards. You need to go find that loan sponsor now before you even have a deal. Start building that relationship with that loan sponsor, letting them know right now kind of what you're looking for and how you're going to be going out looking for it, and building that relationship with them because, again, they're putting up their balance sheets to be able to allow you to be able to have a loan sponsor to be able to allow you to be able to acquire these properties. So you're not just going to be able to find anybody and just say, hey, I got it under contract today and I needed to close tomorrow and be able to find a loan sponsor. It doesn't work that way. It's a relationship business. You got to build that relationship with that loan sponsor first, and then you can have that deal follow suit after that, right? You don't want to get that backed up. So make sure that you do that. And then, of course, how is the loan sponsor paid? The loan sponsor is usually paid in two different ways. So first off, they're usually given a portion of the GP equity in order to be compensated for their use of their balance sheet, right? That's one of the ways that they get paid is the share of the balance sheet. Now, I mean, it's not the share of the balance sheet, it was the share of the GP splits, right? So if you are, I typically recommend between 10 to 20% of the GP is allocated to that loan sponsor to be able to do that offering with you, right? But it depends on the size of the deal. Sometimes it might be more, sometimes it might be less, right? So that 10 to 20% is kind of like a ballpark range of where it would likely fall. But I've seen it as high as 40 and 50%, depending on what else that loan sponsor brings. Because many loan sponsors want to bring additional money to the table as well. So they might even bring in some of their own investors to the table. And so they're bringing more efforts to the table as well, right? And so, or they might want to participate more actively in the asset management duties as well. So make sure that when you're asking your potential loan sponsor about how they want to be compensated, you ask them those things as well, right? And so portion of the GP is one thing. And then, of course, they're going to get a share of any fees or income or anything from the GP based off of that percentage, whether it be acquisition fees, asset management fees, disposition fees, et cetera, unless there's some other pre-negotiated amounts. Now, the second way is typically the loan sponsor will have some form of guarantee fee that is paid up front. And this can usually range between 1% to 3% of the loan balance or the total transaction, right? And that would be paid upon closing. And the reason why this is paid like this is because the loan sponsor has to maintain that net worth and liquidity throughout the entire life of the loan. So at any point in time, they cannot drop below that liquidity requirement or the net worth requirement. And so this additional fee helps to compensate them for having to basically do nothing with their money other than keep it in liquid securities or put it into a bank account, right? So it's additional compensation for that loan sponsor. Now, I'm going to open up for some questions here, but while I do this, let me if I can pull up the screen here and see if I have some questions that have already come in here. And then while you guys are coming up with some questions here, because I don't see any in here just yet, I do want to give you the name. I'm going to give you a little bonus here today. I'm going to give you the name and phone number of a loan sponsor that you can reach out to. So I'm going to have Melissa type this information in. Let's see here if I can find this. And some of you may have heard of him before, but I'm going to give it to you anyway. His name is Alex Kogan, ALIXKOGAN. And I'm going to give you his phone number here, 970-759-5959. So it's 970-759-5959. My recommendation for you would be to send him a text message and ask to schedule a phone call with him to discuss him being a potential loan sponsor for you. So we've got to type there into the chat box. For those of you who are joining us live, you can certainly do that and reach out to him. His website, just so you know, let's see if I can pull it up here. His website is ashlandcapitalfund.com. That's ASHLAND, the word capital, CAPITAL, fund, FUND.com. So you can research him a little bit more if you'd like and find out his bio, his portfolio, things like that on his website. And that's ashlandcapitalfund.com. So you didn't know I was going to give you that little bonus or little nugget there. So how do you find one? You follow the Multifamily Investor Nation, and you can say thank you by registering for the MFIN Summit coming up in June, right? So we try to get information to you as possible. Hopefully that'll help you be able to find a loan sponsor. But obviously you can research him a little bit further by going to his website and sending him a text message about potentially being a loan sponsor for you. So I'm going to open up for some questions here. I do see one in here right now. So let me go ahead and read that and go ahead and answer it. And anybody else has any further questions about loan sponsors or loan guarantors or the process or anything like that, feel free to type it in. I'll open it up for probably another 5 or 10 minutes or so, and then we'll answer some of those questions, and then we will wrap things up. So I got a question on here is, how often do the banks do a review of the loan sponsor's financials to check net worth? It depends on the bank, right? So every bank is going to have a different policy in place. So it might be yearly, it might be every other year, it might be every quarter, right? But you don't really know. And so that's the thing is that the banks don't tell you, we're going to ask you to submit your financials every X amount of time. So you have to maintain as the loan sponsor that net worth and liquidity, because at any point in time, they'll say, I want you to provide us with your last month's ending statements to show us what your net worth and liquidity is. And so you have to keep that in mind. And so there's not any particular hard and fast rule. It's just, you have to make sure that you're always prepared to be able to give that. All right. So let's look at the next question that's coming in here. All right. What are the amounts and percentages that the loan sponsors are typically paid? And what are the ranges if there is no typical amount? So as far as the amounts and the percentages for the loan sponsor, on the GP side, we mentioned this already. It's usually between about 10 to 20% of the GP, depending on a couple of different factors, right? So depending on the loan amount, depending on the loan size, or I guess it's the same thing, loan amount and loan size, depending on the deal size, right? How large the property is. And then also probably depends on maybe what their tolerance is for the DSCR and various maybe break-even analysis that happens on the property as well. And then what are the ranges if there is no, okay. So as far as the fee is concerned, so the loan guarantor fee is going to be usually anywhere between 1% to 3%. So if it's a little bit higher balance loan, maybe it's closer to 1.5%. If it's a smaller balance loan, it might be closer to maybe 3%. I've even seen it as close as like 4% and 5%. Right. So you want to keep that in mind when you're doing your underwriting to make sure you include those fees so that you're ready for that whenever you need that loan sponsor. The next question in here is, do loan sponsors do particular asset classes outside of multifamily like self-storage? So self-storage is a little bit of a different animal than multifamily. So in self-storage, there's going to usually be a guarantor there that's going to have a recourse loan. There's not as many non-recourse lenders in self-storage as there is with multifamily. And so you might actually have a harder time finding a loan sponsor for the self-storage side of things, which is why most people in self-storage stick with some of the lower or the kind of the smaller assets where they could be their own loan sponsor or loan guarantor on it. But it is a little bit more challenging in the self-storage space. But there are loan sponsors do usually pick a particular asset class, and then they'll also pick a particular asset class within an asset. So, for example, certain loan sponsors will only do Class A or Class B type loans or assets, right? But they don't want to go into the Class C or the Class D space, right? And so there's other loan sponsors that the only thing that they want to do is Class C, right? They have their systems in place and they want to only do that kind of maybe lower end B and C class assets. So when you're interviewing and talking to loan sponsors, make sure you ask those questions. When you talk to other loan sponsors, guess what? They might know other loan sponsors, especially if you need multiple loan sponsors to be able to meet a certain net worth and liquidity requirement. So being able to ask those loan sponsors, hey, who else do you know that has a high net worth and liquidity or that might be doing loan sponsorship work so they can help meet those requirements? And so make sure you're asking those questions to the loan sponsors. The next question here. Typically, how much investment or management experience does a loan sponsor need to qualify for the loan? Well, this is kind of interesting because there are some people that have zero experience in multifamily at all, or even real estate investing at all, but because they have the net worth and they have the liquidity, they can come alongside somebody who has experience but doesn't meet the net worth and liquidity and still qualify for the loan, right? Because the lender is looking at the team as a whole, right? Even if one person has the net worth, one person has the liquidity, and the other person has the experience, combined, they meet the requirements, and that's all that they're looking for, right? They want to make sure that somebody on the team has the ability to meet those requirements, right? Or the combined team meets those requirements. So they look at everybody individually, but they look at it as a whole entity itself. So not one person has to have all three of these things, right? So make sure that when you're looking for those loan sponsors, that you make sure you understand what kind of qualifications they actually have. Because if they have qualifications of maybe you have no experience managing a $25 million property, but they only have experience managing a $5 million property, there might be a little bit more of a challenging gap there. And a lot of it just has to do with asking the lender those questions, right? And the agency lenders, Fannie Mae and Freddie Mac, a little more stringent when it comes to that. But when it comes to the private lenders, like the bridge lenders, the life cos, CMBS, things like that, they're a little bit less stringent when it comes to those requirements. So make sure that you're asking your lenders some of those hard questions to see what kind of loan sponsors you need to make sure that you're lining up for your deals. If you have multiple loan sponsors, do they split the GP equity and guarantor fee? The answer to that question, Kevin, is yes. So if you have multiple loan sponsors that you're using to be able to qualify for the net worth, liquidity, and experience on a loan, then there's usually that amount of the GP equity that you're going to give them for compensation would be split amongst those loan sponsors or anybody else who's part of the loan or part of the loan package or as a guarantor. Same thing with any type of guarantor fee or anything like that. That percentage is split. So if you have 3 loan sponsors to meet the requirements, you don't have to give each one of them like 10% each. So you're giving up 30%. If you've allocated, say, 15 or 20%, you split that 15 or 20% amongst whoever you have available as the loan sponsor. Let's see. I spoke with a loan guarantor. This is from Carlos. Good to have you on here, Carlos. I spoke with a loan guarantor and he said he would be willing to be a loan guarantor for me. What should I ask them for as far as soft commitments, any other upfront documentation? So as far as documentation is concerned, you might want to ask them for a PFS or an SREO. Will they give it to you? Maybe so, maybe not, right? Some loan guarantors are very private, right? And they'll say that they'll provide that information to the loan broker, right? So if you're working with a broker, say, well, you can just submit this information directly to the loan broker so they can verify this before I go look for a property, right? And they can give all that personal financial information to them so they can verify whether or not they are actually qualified. And so other than that, it's kind of hard to do any type of like soft commits or anything like that, other than maybe asking them, hey, how much would you be willing to also put in as far as skin in the game alongside the investors on inside of a project? Because many times the lenders will require that the loan sponsor puts up money alongside the investor so that the lender knows that the loan sponsor on the deal also has money invested. So those are additional good questions to be able to ask of how much would you be willing to invest inside of a deal when we put it together for one that you're actually being a loan sponsor on. So good questions there. Looks like I have some questions here in the Q&A box. Let me look at this. Sorry about that. I was kind of going off just the chat box there. All right, I got the part about the net worth requirement, but can you review again the liquidity requirement? Is it a percentage of the loan amount? Yes. So Dan, great question there. So the net worth obviously is you have to have a the net worth of the loan balance, and then the liquidity requirement is typically 10% liquidity of the loan balance. So if you have a $10 million loan balance, you must have $10 million in combined net worth or $1 million of combined liquidity. Next question here. What are the financial obligations of the loan sponsor in regards to guaranteeing the loan? I got on a few minutes late and may have missed that info. All right. So what are the financial obligations of the loan sponsor in regards to guaranteeing a loan? So as far as the financial obligations, depending upon whether it's recourse or non-recourse, would mean that if there is a default on the loan, then that loan guarantor, the bank could go after their personal assets to satisfy the loan, right? If for some reason, once they sell the asset and any cash flows off the asset don't actually support or repay or recoup the loan balance, then they could go after your personal assets as a loan guarantor in a recourse setting, all right? A recourse loan. And a non-recourse loan, that's not usually an option unless they can find some sort of like fraudulent activity or negligence or falsified financial statements or tax returns or anything like that could cause it to go from non-recourse to recourse. Okay. Now, if you're the lender, you're going to probably try to find as much information as possible if for some reason they default, if the loan balance is not satisfied, to make sure that your loan balance is satisfied, right? So if you have all of the abilities to be able to do a lot of research to figure out, did they falsify financial statements in the beginning when they were showing their financial aptitude, or the maybe falsifying tax returns, all of that could be investigated. And if there's a default, it can convert it from a non-recourse to a recourse loan. So you want to make sure that you're very careful with when it comes to that. But as far as the other financial obligations of a loan guarantor, it's really a matter of making sure that you maintain that net worth and liquidity during that loan period. All right, let's see here. We've answered that one, answered this one. Does GP mean gross profit? No, the GP split is the general partnership. So the GP is the general partnership or the operator splits. So typically in a typical multifamily deal, you might have a 70-30 split. So 70% is going to be allocated for the LPs, the limited partners, and then the GP is going to have that other 30%, right? So that's going to be the general partnership of that particular deal when you're putting it together. So great question there. All right. Can someone's a personal residence be used in determining their net worth as a loan sponsor? And the answer to that is yes, that is correct. You can use your personal residence to get to the net worth perspective of becoming a loan sponsor. Now, the reason why this question is coming up is because when you're trying to determine whether or not somebody is an accredited investor or not, to become an accredited investor, one of the qualifications is that you have to have $1 million of net worth. That does not include your primary residence. So that's the distinction is whether you're an accredited investor or you're just trying to show your net worth for sign on a loan. Does not matter as far as the personal residence is concerned when it comes to signing on the loan. So great question there. I'm going to take 2 more questions here and then we'll go ahead and wrap it up. So let's say the GP comes with a 30-70 split or 70-30 split with the LPs. So the loan sponsor usually gets 10 to 20% of the GP, 30% split. Yes, that's correct. But when I say 15 to 20 or 10 to 20%, it's not that they get 10 to 20% of the overall deal. So meaning that you're not going to get 10%, they're going to get 20%, and the investors are going to get 70%. That's not what I'm saying. We're talking about the 30% as a whole. They're going to get 10 to 20% of the 30%, right? So you're going to be splitting the GP side between 10 to 30% or 10 to 20% of for that loan sponsor. So hopefully that makes sense. We're not basically just giving them a larger portion of that. We're basically just saying, okay, of the 70-30 split, 30% is allocated to the general partners, and of that 30%, they're going to get 10 to 20%. So if you want to look at it that way, they're going to get 3 to 6% of the GP or of the actual deal itself. Make sense? All right, good. All right, last question here is, we already kind of talked about the risks. What is the loan sponsor's risk of non-recourse loan? We kind of already talked about that, so I won't go over that again. What level of information should the GP be prepared to share regularly with the loan sponsor? Very little at all. So it's not necessarily that the what level of information should the GP be prepared to share? I misunderstood your question here. So what level of information should the GP be prepared to share regularly with the loan sponsor? So as the loan sponsor, you should be asking for multiple things. So you should be asking for monthly financials, T12, rent roll, balance sheet, and also making sure that you get the account statements as well, so you can have that full understanding as to what's happening. And then you also would likely want to see the balance. I mean, the loan statements to make sure that the payments are actually being made, right? And so those are some things that you would definitely want to make sure that you have ready and prepared to be able to provide to the loan sponsor on a regular basis. Now, not all loan sponsors are picky, so they don't ask for that kind of stuff, but you definitely want to make sure as a loan sponsor, if you're looking at doing that, you're asking for that information. So, all right, so that's all the time we have today for the questions. I want to thank each one of you for being here. Let me see what the next week's topic is. See if I can refresh my screen here real quick. All right, next week on Tuesday, May 4th, you're going to have Brandon Abbott here. He's going to be talking about the importance of reputation within the apartment syndication industry. So he's going to be talking about how to improve your reputation, what speaks louder in this industry, how to stand out in the crowd, and how to maintain your standing. So make sure that you participate and you register for that next webinar that's coming up next week. And in the chat box here, we can maybe type in the link. You can go to multifamilyinvestornation.com/MFIN webinar to be able to do that. And don't forget to register, or not register, but to subscribe to our podcast. So we actually interview active investors that are closing real deals every single week. So make sure that you go check it out. Go to mfinpodcast.com, or you can look us up on iTunes, type in multifamily. And if you've been listening and you've been reviewing it and you're already a subscriber, help us out, post a review, do something, give us 5 stars. We really appreciate that. Look forward to seeing you back here next week, as well as at the MFIN Summit in June. So thank you so much.